In 1993, America had exactly one ETF. Today, it has almost 5,000. More ticker symbols than there are public companies to actually buy. $19 trillion now sits inside these things worldwide. But here's the part nobody explains. They are not all the same animal. Some are the safest way on earth to own the market, and a few are quietly designed so you can lose money even when you're completely right. By the end, you'll know every type and exactly which ones bite. So what is an ETF, really? 3 letters. Exchange Traded Fund. Forget the jargon. Picture a basket. Inside that basket, someone has placed dozens, sometimes thousands of individual investments. Stocks, bonds, gold, whatever. Then they slice the whole basket into shares and list it on the stock exchange. So instead of buying 500 companies, one painful click at a time, you buy a single share of the basket. And you instantly own a sliver of all of them. That's the first superpower, instant diversification. The second is cost. A traditional mutual fund might charge you 1%, even 2% a year for a human to pick stocks. A plain index ETF can charge 0.03%. On $10,000, that's the difference between $200 a year and $3. The third is freedom. A mutual fund prices once after the market closes. An ETF trades all day long, just like a stock. And behind the scenes, a clever swap between the fund and big traders keeps the price glued to the real value of the basket, and quietly makes ETFs far more tax-friendly than the funds your parents owned. 1 wrapper, 3 superpowers. Now, let's open the zoo. Start with the kings, index ETFs. These don't try to beat the market, they try to be the market. The very first ETF, born in 1993, did exactly one thing. It copied the S&P 500. Today, its descendants, names like VOO and VTI, let you own the 500 biggest American companies, or the entire US stock market in one share. There are bond versions too, holding thousands of loans at once. Why are these the core of almost every smart portfolio? Because they're brutally cheap, endlessly diversified, and they quietly win. Over any 20-year stretch, the boring index beats the vast majority of expensive professional stock pickers. This is the slice most experts say should be the foundation, the calm center of the whole thing. But a calm center is boring, and humans do not buy boring, so the industry built flavors. Flavors. If a broad market ETF is the whole pizza, a sector ETF is a single slice. Want only technology? There's a basket for that. Only energy? Only banks? Only healthcare? 1 ticker each. These let you bet on a part of the economy without gambling on one single company blowing up. Then things get spicy. Thematic ETFs. Instead of a boring sector, they chase a story. Artificial intelligence, robotics, clean energy, even space. They're exciting, they market beautifully. And that is exactly the trap. Studies show the hottest thematic funds often launch after the hype has already peaked. So you buy the theme right as the easy money is leaving the building. The narrower the basket, the wilder the swings. Sectors and themes aren't wrong, they're tools. But they're a side dish, not the meal. Speaking of which, what if you don't want growth at all? What if you just want to get paid? Meet the income family. Not everyone is trying to get rich fast. Some people just want a check. Bond ETFs hold giant piles of loans, to the US government, to big corporations, and pass the interest straight through to you. The safest ones hold short-term treasuries. The riskiest hold high-yield debt, which is a polite name for loans to shakier companies that pay you more precisely because they might not pay you back. Then there are dividend ETFs, which bundle hundreds of companies famous for mailing cash to shareholders every quarter. The purpose here isn't fireworks, it's a smoother ride and a steady stream of income, the kind retirees lean on. And here's the quiet magic. These tend to fall less when the market panics. They're the shock absorbers of a portfolio. But everything so far, stocks, bonds, dividends, lives inside the normal financial world. So what about the stuff that doesn't? Gold, oil, Bitcoin. This is where ETFs leave the stock market entirely. A commodity ETF lets you own gold, real, physical gold, sitting in a vault, just by buying a share. No safe required. There are baskets for oil, for silver, even for farm crops. People buy them as a hedge. When stocks and the dollar wobble, gold often zigs while everything else zags. There are currency ETFs too, for betting on the dollar or the euro. And then, the new arrival that broke every record. In January 2024, America finally approved the spot Bitcoin ETF, a basket that simply holds Bitcoin for you, no wallet, no keys. One of them, BlackRock's iBit, reached $80 billion faster than any fund in history. The famous S&P 500 fund took 5 years to hit that mark. The Bitcoin ETF did it in barely one. For better or worse, crypto walked straight through the front door of Wall Street. These are the diversifiers, the ingredients that don't move in lockstep with everything else, which leaves one last room in the zoo, the one with the warning sign on the door, the room with the warning sign. First, active ETFs, where a manager actually picks the holdings instead of copying an index trying to beat the market. A few are brilliant, most over time are not. Then the genuinely dangerous two. Leveraged ETFs promise 2, even 3 times the market's daily move. Triple the gains. But read that word carefully. Daily. Because they reset every single day, a choppy market grinds them down through something called volatility decay. And here's the answer to the question I opened with. A triple leveraged fund can lose money over a year, even if the index it tracks ends exactly where it started. You can be completely right about the direction and still bleed. Inverse ETFs are the mirror. They go up when the market goes down. Handy for a quick hedge, financial poison if you forget about them and just hold. These aren't investments. They're short-term trading tools wearing an ETF costume. Powerful in skilled hands, quietly expensive in everyone else's. So here's the entire zoo on one page. Picture 2 buckets. The first, call it your core, is the boring, beautiful center. Broad index ETFs, maybe a bond ETF for ballast. Cheap, diversified. The part that quietly compounds for decades. That's most of the money. The second bucket, call it explore, is everything else. A sector you believe in, a theme, a little gold, a sliver of Bitcoin. The fun money, the part you can afford to be wrong about. And the single most important question for any ETF is, never will it go up. It's 2 boring questions. What's actually inside the basket? And how much does it cost me to hold it? Read those 2 things, and you understand more about an ETF than most of the people who own it. If this made the alphabet soup finally make sense, hit subscribe. That's how the channel grows. Next time, we crack one of these baskets open and watch how that magic swap keeps the price honest. Until then, stay curious and stay diversified.